Have you ever looked at prices, maybe, the cost of your groceries, fuel for your car, that new table, and just wondered, where are these prices actually going? How do economists, or businesses for that matter, even start to guess what things might cost next month or even next year?
It's a huge question. And predicting the future of prices, well, it's incredibly important, isn't it?
Absolutely. It guides businesses in figuring out what to make, how much to charge. It helps investors understand the economic climate. And it's vital for you, just planning your household budget or making bigger financial moves.
So, what if there was this economic signal? An indicator that could give us an early peek at these price changes, something that captures them before they, filter all the way down to the consumer level.
That upstream signal, that early warning system, that's exactly what we're going to unpack today, right?
Precisely. We've gathered a whole stack of sources here, some really fascinating research papers, detailed economic analyses, quite insightful blog posts, even some specific forecast data. And they all center on this one powerful, maybe sometimes overlooked, indicator, the Producer Price Index, the PPI here in the U.S.
Okay, let's dive right in then. Our mission for this deep dive is to pull out the most valuable bits of knowledge, the key insights from all these different sources.
Yeah, we want to give you a really clear picture of what the PPI actually is.
And lift the curtain a bit on how it's put together, why it matters so much in the bigger economic picture.
And critically, evaluate just how good it really is at forecasting future inflation, especially the kind you see every day, the consumer inflation.
Exactly. The goal is to help you get better informed, understand these economic signals buzzing around us, maybe spot something you wouldn't have otherwise.
So where do we kick things off?
Well, the beginning seems like a good place. What exactly, at its heart, is the Producer Price Index?
Okay, so think of the PPI as measuring prices, but from the seller's viewpoint. Specifically, the domestic producer selling their output for the first time commercially.
The first transaction.
Right. Our sources define it pretty consistently as the average change over time in the selling prices received by domestic producers for their goods and services. It's the price at the factory gate, you could say, or the warehouse door, or the point where a service company sends out its first invoice.
Okay, so before it gets marked up by wholesalers or retailers.
Exactly, before it moves further down that supply chain towards the final consumer.
And that immediately flags up the big difference compared to the index most people know, right? That's the CPI, the Consumer Price Index.
Absolutely. That distinction is fundamental, and the sources really hammer this home. CPI is all about the prices you pay as a consumer when you buy stuff directly.
What it costs me at the store.
Precisely. PPI is about the prices producers receive when they sell their output. It's measuring cost pressures from the supply side, the production side of the economy.
And the details matter too, don't they? Like what's included or excluded.
Oh, definitely. The differences in what they capture are significant. For instance, CPI includes prices for imported goods because, well, consumers buy imported goods.
Makes sense.
But the PPI, it strictly focuses on prices received by domestic producers. It's measuring U.S.-based production output.
Gotcha. U.S. factories, U.S. farms, U.S. service providers.
Right. And another key difference our sources highlight is sales tax. CPI includes sales taxes. They're part of the final price you pay.
Yeah, unfortunately.
PPI doesn't include them because that tax isn't revenue the producer actually receives for their output. So, you see, they're designed to reflect totally different points in the economic flow. Production versus consumption.
And this whole idea tracking producer prices.
Yeah.
It's not some newfangled thing, is it? It has some history behind it.
Oh, it really does. The concept isn't new at all. The U.S. Producer Price Index system actually has roots way back in the early 20th century.
Wow, really?
Yeah, it was initially set up to monitor price movements in wholesale markets. Over time, it evolved into this much more comprehensive measure of producer prices we have today. Its long history just underscores how fundamental it is as a tool for spotting and tracking inflation pressures right at the source, within the production economy.
So why is this index, the one measuring prices before they even hit the stores, why is it so important? Who really pays close attention to it, apart from, say, economists at the Fed?
Oh, quite a broad group, actually. For economists, yeah, it's absolutely crucial. They use it to gauge cost pressures building up in the system, to forecast where prices might be headed.
And policymakers, like the Federal Reserve.
They watch it like hawks. A sustained rise in PPI, especially in key areas, can be a warning sign. It signals potential future inflation that might need a policy response, like tweaking interest rates maybe before it fully spills over into consumer prices.
Trying to get ahead of the curve.
Exactly. Investors, too. They monitor PPI data closely. Unexpected jumps or falls can shift market thinking about inflation, interest rates, even corporate profits. That influences decisions on stocks, bonds, commodities, a whole lot.
And what about actual businesses, the ones making things or providing services?
Hugely important for them. Understanding PPI trends helps business leaders forecast their own input costs. They can anticipate pricing trends for what they sell, make smarter decisions about production levels, manage inventory better, optimize their supply chains.
So if the price of steel is going up in the PPI,
A company using steel knows its costs are likely heading up. It helps them plan, maybe renegotiate contracts, or even decide on pricing strategies. It's a vital piece of the puzzle for anyone trying to read the economy from the supply side. It sits right alongside other big indicators like jobs data, giving a different but complementary perspective.
okay, we know what it is, why it matters, but the nitty-gritty, how do they actually build this index? How do you take millions of price points and boil them down into one number each month? What's that process look like?
Well, it's a pretty major statistical operation run primarily by the Bureau of Labor Statistics, the BLS, here in the U.S.
The BLS, right.
The foundation is this massive survey program. They collect literally millions of price quotes every single month directly from domestic producers.
So manufacturers, mining companies.
Agricultural producers, and increasingly service providers, too. They gather this through surveys, questionnaires, sometimes using administrative records that businesses provide.
So the BLS is basically ringing up businesses and asking, hey, what did you charge for that widget this month?
Kind of, yeah. They survey thousands of businesses, collecting prices for specific representative products or services month after month.
And is that all? Just the survey data?
That's the core, but it's supplemented. They pull in information from other places too, trade associations, other government agencies, publish data like commodity market prices just to make sure the coverage is as comprehensive as possible. Then the BLS crunches all those numbers and releases the aggregate PPI data monthly.
And there's a formula involved, I assume. It can't just be a simple average of all those prices.
No, definitely not. It's more sophisticated. Our sources mention they use statistical index formulas, primarily a version of something called the Last Bears Index.
Last Bears. Okay, what's the concept there?
Conceptually, the idea is you're measuring the change in the cost of buying a fixed basket of goods and services over time.
A fixed basket. Like a shopping cart that never changes.
Exactly. Imagine you bought a specific quantity of everything in the PPI basket way back in the base period. The Las Vegas Index tracks how much it would cost to buy that exact same basket today compared to what it cost back then.
And what's the base period for the US PPI?
It's 1982. They set the index value for 1982 to 100. So if the PPI for, say, finished goods is 250 today, it means the average price for that fixed basket of finished goods has risen 150% since 1982.
Okay, you mentioned weighted average earlier. How does that fit in?
Ah, yes. That's crucial for making it meaningful. Not everything produced has the same economic impact, right? A ton of steel matters more to the overall economy than, say, a handful of paper clips.
Right.
So the prices are weighted. Each item or category gets weighted based on its relative importance, basically, its share of the total value of domestic production. The BLS figures out these weights from detailed industry surveys.
So bigger industries, bigger products have more influence on the final number.
Precisely. Items that make up a larger share of producer sales get a heavier weight, so their price changes move the overall index more. These weights get updated periodically, but between updates, the index tracks price changes for that fixed basket composition.
It sounds incredibly complex. Gathering all that data, weighting it, adjusting it, month after month. Are there challenges, limitations in this process?
Oh, absolutely. While the BLS uses really rigorous methods, calculating something this vast is never going to be perfect. Our sources point out a few limitations.
Like what?
Well, one is just data collection variability. Getting consistent, accurate price reports from thousands of very different businesses across all sorts of industries. That's tough.
I can imagine.
Then there are time lags. Capturing super rapid price changes, especially when things are volatile, can have a bit of a delay between the actual price shift and when it shows up in the official stats.
So it might be slightly behind reality sometimes.
Potentially, yeah. There's also the risk of sampling bias, making sure the sample of businesses and products they survey is truly representative of the entire domestic economy is a constant challenge.
And what about things like quality changes? A new phone isn't the same as the old one.
That's a big one. They do make adjustments for seasonality, for changes in product quality, for substitutions producers might make. But capturing all those nuances perfectly is really hard. How do you put a price on a much better camera or a faster chip in that new smartphone? Those quality adjustments are complex and can be debated.
I often see the PPI broken down into stages. You hear about crude, intermediate, and finished goods. What's that all about?
Yeah, that breakdown by stage of processing is super insightful. It helps analysts see where in the supply chain price pressures are actually building up. Think of it like tracking prices as raw materials get turned into final products.
Okay, so break it down for us. Crude materials.
These are the raw, unprocessed goods just entering the market. Think crude oil, raw cotton, iron ore, logs, grains, even fresh fruits and veggies. Prices here are often the most volatile, reacting fast to weather, supply shocks, global commodity swings.
Got it. Raw inputs, then intermediate.
These are materials or components that have been processed somewhat, but are going to be used as inputs for further production. Things like steel beams, chemicals, computer chips, fabric, lumber, processed foods, even energy like electricity used by factories. Price changes here show the cost of processing raw materials and are a key signal for manufacturers' costs.
And finally, finished goods.
Right. These are products ready for sale, either for consumption or as capital investment. But crucially, this is before they hit the final retailer or consumer. So it excludes those wholesale and retail markups and sales taxes we talked about.
Examples.
Passenger cars, washing machines, furniture, packaged food from the factory, clothing, that sort of thing.
And then there's core PPI. I hear that term a lot.
Yes, core PPI is usually a subcategory of the finished goods PPI. The key thing is it excludes food and energy prices.
Why exclude those? They seem pretty important.
They are, but they're also notoriously volatile. Food prices can jump around due to weather, energy prices due to geopolitics, things that might not reflect the broader underlying trend in production costs. So looking at core PPI helps economists see past those short-term swings and get a clearer view of the more persistent price pressures driven by fundamental economic factors.
So it smooths out the noise a bit.
Exactly. Though the BLS tracks everything, including food and energy, of course, they also look at prices for services at different stages now, too, although goods have historically dominated the main index. And they have input-output measures, trying to understand the squeeze on businesses, what they pay versus what they get.
This breakdown really helps clarify the flow. And understanding those stages seems absolutely critical for figuring out how PPI might forecast inflation later on.
Right.
Which brings us right to that core relationship.
Yeah.
How does a price change for, say, iron ore or electricity eventually ripple through and affect what you or I pay for a car or our utility bill?
Right. This is where it gets really interesting. It's all about the idea of cost transmission, often called cost push inflation.
Cost push, meaning costs are pushing prices up.
Exactly. When the prices of the inputs producers use those raw materials, intermediate goods, energy, even labor when those go up, it hits their bottom line.
Naturally.
So to stay profitable, or sometimes just to stay afloat, producers often need to pass at least some of those higher costs along to whoever buys from them next in the supply chain.
Okay, walk us through an example, maybe that lumber one again.
Sure. Let's say the price of raw timber spikes that hits the crude materials PPI. The sawmill buying that timber now faces higher costs. They'll likely raise the price of the lumber they sell to builders that hits the intermediate goods PPI.
Okay.
Now the builder's cost for constructing a house goes up. So they, in turn, will likely charge more for the finished house or for that home renovation project. And that eventually shows up in consumer prices like housing costs or renovation services in the CPI.
So the pressure starts upstream with producers.
And flows downstream, stage by stage, potentially reaching the consumer.
And because PPI catches these prices earlier in that chain.
Precisely. That's why it's often considered a leading indicator for the CPI. A significant, sustained rise in the PPI can be like an early warning flare. It signals that a wave of higher costs is moving through the system and is probably going to impact consumer prices down the road.
Like seeing ripples spreading out before the wave hits the shore.
That's a great analogy, yeah. It's like seeing pressure building in the pipes before water bursts out the tap.
Is there solid evidence for this, though? Does PPI consistently lead CPI? Or is it more theoretical?
Oh, there's definitely empirical evidence supporting the link, though it's crucial to say it's not a perfect lockstep correlation. History shows that surges in producer prices, especially for key inputs like energy or across multiple stages, do tend to come before increases in consumer prices.
Especially during certain times.
Yeah, the link often appears strongest during periods driven by supply shocks, think big jumps in oil prices, or major disruptions to global trade where rising input costs are clearly the main inflation driver.
And do economists actually use PPI in their forecasting models for CPI?
They absolutely do. Econometric models designed to forecast inflation frequently include past PPI data as an input variable. Our sources even mention the basic structure, like today's CPI at time t, can be statistically related to yesterday's PPI at time t1, plus other factors, of course. This formally acknowledges that statistical relationship changes at the producer level do seem to have predictive information for what happens later at the consumer level.
That makes a lot of intuitive sense.
Right.
Costs go up for businesses, they'll try to charge more. But is just looking at the headline PPI number enough for a good forecast? Or can adding other data make the prediction better?
Oh, now you're getting into the really interesting findings from that scientific research paper we looked at. It specifically dug into how adding external factors, things like commodity prices, crude oil prices, could improve the accuracy of forecasting month-on-month changes in both CPI and PPI.
And what kind of models did they use?
They used some pretty advanced time series models, ARMAX models. The X stands for those external variables. They crunched data from mid-2018 right through to the end of 2023.
Okay, and what did they find? Does adding that extra info actually help?
The short answer is yes. A key takeaway was that the models with that external information consistently did a better job forecasting both CPI and PPI compared to simpler models that just relied on past price data alone.
So context matters.
Absolutely. It tells us that while PPI itself has predictive value, its signal gets sharper, more useful when you see it in the context of what's happening in broader markets, especially with key raw materials and energy. You can't just look at the PPI number in a vacuum. Understanding its drivers really boosts its forecasting power.
And did they find that certain external factors were better predictors for CPI versus PPI? Did it matter which extra data you added?
Yes, and this is fascinating because it really underscores how different the two indices are. The study found that crude oil futures prices were particularly significant for improving CPI predictions.
Crude oil for consumer prices. Why?
Well, think about what consumers buy, as the research suggests. Crude oil is a fundamental input for so many things consumers use directly or are heavily influenced by. Gasoline, obviously, but also plastics, transportation costs, heating oil.
Right, it touches a lot of consumer goods and services.
Exactly. So changes in crude oil prices tend to have a more direct, maybe more immediate downstream impact on that consumer basket measured by the CPI.
Okay, so crude for CPI. What about for PPI?
For PPI forecasts, the study found that broader commodity price indices were more helpful.
Broader indices, meaning tracking a whole basket of raw materials.
Precisely. Remember, PPI covers that huge landscape of production inputs, metals, agricultural goods, chemicals, all sorts of stuff. A broad commodity index, which tracks a basket of these varied raw materials and intermediate goods, gives a more comprehensive picture of the overall input cost pressures hitting a wide range of producers.
Which index did they use for the U.S.?
For the U.S., they use the RJCRB index, which is a well-known broad commodity index. And their models showed that was the most critical external factor for predicting U.S. PPI. So while oil is important for producers too, that whole basket of commodities seems to be a better signal for overall producer costs.
Interesting distinction. And they looked at different types of crude oil too, didn't they? WTI, Brent. Did that matter?
Yes, they did. And the results were pretty clear on this. Within their study period, they found that WTI crude oil futures West Texas Intermediate consistently did a better job forecasting CPI than IN crude oil futures did for both the U.S. and China, actually.
WTI was better for predicting consumer inflation.
That's what they found. They suggest WTI carries more relevant information about price changes hitting the consumer sector specifically. Brent crude was also in the mix, but WTI seemed to have that stronger predictive link to CPI.
So the specific oil benchmark matters.
It seems to, yes.
Yeah.
Especially if your goal is predicting consumer-level inflation. WTI appears to be a particularly potent signal based on this research.
Okay, so let's recap those research findings quickly. If you want a better signal for consumer price inflation, watch WTI crude futures closely.
Right.
But if you're more focused on producer price inflation signals, keep an eye on a broad domestic commodity index like the RJCRB for the U.S.
Based on that specific study, its methods and time frame, that's exactly what the results point towards. It really highlights the complexity. Different indicators give you the strongest signal for different parts of the economy and different price indices.
Speaking of looking ahead in the specific signals, we actually have some forecast data here from one source, the Financial Forecast Center. They provided predicted U.S. PPI values for all commodities running from April 2025 through December 2025. This was as of their update in mid-May 2025.
Yes, this gives us a concrete snapshot of a real-world forecast using a model that likely incorporates some of these ideas we've been discussing.
And what does their forecast show?
Well, as of that date, their forecast for the U.S. PPI, all commodities, showed a generally downward trend predicted for the rest of 2025.
Interesting. What were the numbers?
They had April 2025 at 258.7, then May dipping to 256.9, June down to 254.9, July slightly lower at 254.0, then a bit more of a drop in August to 250.7, and September to 247.7.
So a steady decline through the summer.
Pretty much. Then there was a tiny predicted uptick in October to 248.0, but the downward trend resumed in November at 242.4, ending December at 239.0.
So this particular model back in May was seeing producer prices generally falling through the year end. Now, what does this source say are the causes driving their PPI forecast? What inputs matter most in their model?
Okay, their methodology points to several key drivers. Unsurprisingly, given our discussion, they list crude oil prices right at the top, specifically mentioning both WTI and Brent.
Makes sense. Oil up, PPI up.
Their model shows that clear link, yes. When crude goes up, they predict PPI goes up, following that cost-push logic we talked about.
What else?
Another energy input they highlight is natural gas, specifically the Henry Hub price, which is a major North American benchmark.
Same logic. Gas prices up, PPI up.
Exactly the same logic stated in their methodology. Natural gas is a huge energy source for industry, so its price directly impacts production costs across many sectors.
Okay, oil and gas. Standard culprits. But this next part from their methodology really caught my eye. They list specific currencies as causes influencing the U.S. PPI forecast. They name the Canadian dollar, the Australian dollar, and the Singapore dollar. How on earth do exchange rates for CAD, AUD, and SGD affect U.S. producer prices?
Yeah, that's where things get really interconnected globally, isn't it? The Financial Forecast Center does explain the link, though it's a bit indirect.
How so?
They state that as the Australian dollar, AUD, Canadian dollar CAD, and Singapore dollar, SGD, strengthen against the U.S. dollar, their model predicts the U.S. PPI will go up.
A stronger AUD or CAD means higher U.S. producer prices. That seems counterintuitive.
The reason they give for this connection is that these specific currencies also play a significant role in influencing crude oil prices globally.
Ah, so it's a link through the energy markets again.
Exactly. Think about it. Canada and Australia are major commodity exporters, including oil. Their currency values are often tied to commodity prices.
Right, the commodity currencies.
Precisely. So their model seems to capture this complex dynamic. Currency movements in these key commodity-linked economies can affect global crude oil prices. And since crude oil is such a primary driver of U.S. PPI in their model, those currency fluctuations end up indirectly nudging the U.S. PPI forecast.
Wow, that's a great example of how you really need to look beyond just domestic factors these days, especially for forecasting.
Absolutely. It shows how integrated things are. This specific forecast methodology apparently pulls together prior PPI data, various commodity prices, these specific currency rates, and probably other economic indicators to generate its predictions.
Okay, so we've got the definition, the calculation, the link to CPI, how extra data helps forecasting, and even a specific forecast pointing to drivers like oil, gas, and certain currencies. But, and this is a big but our sources emphasize, the PPI is not a perfect crystal ball, is it?
Not even close. This is really critical for anyone using PPI data to understand. While it's valuable, several major factors limit how accurately it can predict overall consumer inflation trends all by itself. You definitely can't just say, PPI went up 1%, so CPI will go up 1%. It doesn't work like that.
So what are some of the biggest limitations? Where does it fall short?
Well, one huge one, mentioned by several sources, is the difference in coverage between goods and services.
Ah, right. PPI is more about physical stuff.
Historically, yes. It's been much more comprehensive at tracking prices for goods at all those production stages. But think about modern economies like the U.S. services are a massive and growing part of what people spend money on.
Healthcare, rent, education, haircuts.
Exactly. Healthcare, housing costs like rent, education, insurance, entertainment, transport services, the list goes on. And these services often have very different cost drivers than manufactured goods, things like labor costs, regulations, specific demand patterns.
And PPI doesn't capture services as well.
Its coverage of services has improved, but it's still generally considered less comprehensive than its goods coverage. Since services are such a huge chunk of the CPI basket, PPI's relative weakness there limits its ability to predict the whole CPI accurately. A rise in goods PPI might not mean much for overall inflation if services inflation is flat, or vice versa.
Okay, that makes sense. What else limits its predictive power?
Another thing is supply chain volatility and temporary shocks. We talked about those stages, raw materials, intermediate goods. Their prices can be super sensitive to short-term disruptions.
Like natural disasters, geopolitics.
Exactly. A hurricane hits a farming region, a geopolitical event messes with oil supplies, a shipping bottleneck holds things up. These can cause sharp, sudden spikes in specific PPI components.
Like that example from early 2025 you mentioned.
Right. One source highlighted that a big jump in U.S. PPI in January, mostly driven by energy and food, but then it fell back in March. These kinds of short-term jolts in PPI don't always signal a lasting, broad inflation trend that's going to hit consumers hard over the long run. They can be misleading noise if you're not careful.
So a temporary spike in oil doesn't automatically mean sustained high gas prices forever.
Not necessarily. And related to that is another key point. Producers don't always pass on all their cost increases.
They might just absorb the cost.
They might, yeah. How much of a producer price hike actually gets passed downstream depends a lot on market conditions. If an industry is super competitive or if consumer demand is weak, businesses might choose to eat some or all of that cost increase themselves.
Why would they do that?
Because they're afraid of losing customers. If they raise prices too much when demand is soft or competitors aren't raising theirs, they could lose market share or just see sales plummet. So they might sacrifice some profit margin instead.
Which breaks that link between rising PPI and rising CPI.
Exactly. That cost push doesn't always get fully pushed through to the consumer. The transmission mechanism isn't automatic.
And even within the PPI itself, some components are just more junky than others. Yeah.
Absolutely. We touched on this with core PPI. That headline PPI number includes food and energy, which can swing wildly for reasons totally unrelated to the underlying economy-wide trend.
Weather affecting crops, global oil politics.
Right. That volatility can really muddy the waters if you're trying to see the true underlying inflation pressure. That's why economists and analysts often zoom in on core PPI. Stripping out food and energy gives a clearer signal.
And comparing core PPI to core CPI.
Yes, one source suggested that's a much better way to spot if underlying persistent inflation trends are really taking hold, rather than just reacting to a temporary spike in gasoline or grocery prices.
Okay, so given all these caveats, these limitations, how do people actually use PPI effectively? How do businesses, economists, policymakers work around these issues?
Well, despite the limitations, it's still a vital tool, mainly because of that early warning feature. For economists, it's essential for diagnosing the health of the production side of the economy, for forecasting potential shifts in the business cycle. It helps them figure out if inflation pressures are coming more from the demand side, which CPI might show more clearly, or from these supply-side cost pressures, where PPI gives the first glimpse.
And businesses, how do they use it strategically?
Oh, extensively. If they see the PPI for key inputs they buy starting to rise consistently, they can react proactively.
Like what?
Maybe build up inventory before prices go even higher. Start looking for alternative suppliers or materials that aren't getting as expensive. They can use the data to negotiate new contracts with their own customers, building in potential future cost increases, or maybe find ways to become more efficient to offset the rising costs.
Let's use that steel example again.
Okay. If the PPI for primary metals like steel keeps climbing, a car company knows its costs are heading north. They can use that PPI data to forecast their expenses more accurately, adjust their production budgets. Maybe they start researching different grades of steel that cost less, or they begin talks with their dealers about future car pricing. It helps them anticipate and adapt, not just react after the fact.
Gives them runway.
Exactly. And for central banks and government.
How do policymakers use it, knowing its flaws?
Well, the Fed and others monitor it very carefully. Now, their main targets for setting interest rates are usually consumer inflation measures, CPI, and especially the PCE index, personal consumption expenditures. Those reflect the consumer experience more directly.
But PPI still plays a role.
It provides crucial context. If PPI, particularly that core measure across different stages, is showing significant, sustained upward pressure, it's a strong signal that cost pressures are broad and building in the pipeline.
The early alert.
Right. It warns them that consumer inflation could accelerate down the line. That might prompt them to consider tightening monetary policy, raising rates, perhaps before the full impact hits consumers, trying to stay ahead of that inflation wave. It's a key input into their forward-looking assessment of inflation risks.
And what about financial markets? Do traders watch PPI releases.
Oh, absolutely. It's a market-moving number. Traders, especially in the bond and currency markets, pay very close attention to the monthly PPI release.
Why? What are they looking for?
They're comparing the actual number to what the market expected. If PPI comes in hotter than expected, it can signal higher potential future inflation. That, in turn, might lead markets to bet that the central bank will raise interest rates sooner or faster than previously thought.
And that affects bond prices, currencies.
Exactly. Higher expected rates tend to push bond yields up and bond prices down. The effect on the currency can be mixed. Higher inflation is usually bad, but higher interest rates can attract foreign investment, strengthening the currency. So traders analyze the PPI surprise factor and place their bets accordingly.
Okay, wow. We have covered a lot of ground here. From the basic definition to complex forecasting models and limitations. Let's try and boil it down. If someone walks away from this deep dive, what are the absolute must-know takeaways about the Producer Price Index?
All right, the essentials. First, PPI is that vital upstream indicator. It captures price changes producers get paid domestically before goods and services hit the consumer.
Different from CPI, which is what consumers pay.
Critically different, yes. No imports, no sales taxes in PPI. It's calculated by the BLS using surveys, weighted averages based on output, and broken down by stage crude, intermediate, finished goods, plus that important core measure stripping out food and energy.
And it's linked to consumer inflation.
Through that idea of cost transmission, cost push, rising producer costs can flow downstream. That's why it's seen as a leading indicator.
But not a perfect one.
Definitely not. We learned forecasting gets much better when you combine PPI with other data. Specifically, that research highlighted WTI crude as a key predictor for CPI, while broad commodity indices like RJCRB were better for PPI forecasts.
And specific forecasts even look at things like oil, gas, and even certain currencies like the Aussie and Canadian dollars as drivers.
Right, showing those global links. But then there are the significant limitations, the goods versus services imbalance compared to CPI, the noise from temporary shocks, the fact that producers don't always pass costs on.
So you have to view it in context.
Absolutely. It's an essential piece of the inflation puzzle, giving you that crucial early warning from the supply side. But it's not the whole picture. Its real power comes when you use it alongside CPI, PCE, commodity trends, global factors, putting all those pieces together.
Okay, so summing up our journey through all these sources, we defined PPI, saw how it's calculated, explored its link to inflation, saw how extra data sharpens forecasting, looked at a specific forecast and its drivers, really unpacked its limitations, but also saw how vital it remains for analysis, policy, and business strategy.
And I think the key lesson threaded through everything is exactly that. No single indicator tells the whole story. PPI is indispensable as that early warning system, right there at the source of production costs. But its signal is clearest, most actionable, when you understand it in relation to everything else. How does it compare to CPI? What are commodities doing? Energy prices, global currencies. It gives you that critical supply side view, which you absolutely need for a well-rounded understanding of where prices might be headed.
And maybe here's a final thought for you, the listener, to mull over. As global supply chains keep changing, getting arguably more complex, and as economies continue shifting towards services and maybe new kinds of energy, how might that traditional relationship between producer prices and the prices you pay actually evolve in the future?
That's a great question. What other signals, maybe ones we don't watch as closely today, might become just as important or even more important than the PPI in predicting the inflation you experience day to day? Something to keep thinking about as you navigate the economic news out there.